Imagine this. Within days of Zohran Mamdani's surprise mayoral win, alarm bells started ringing across Wall Street and Manhattan boardrooms, and not quietly. A wave of executives and business owners began questioning their future in New York City. Some are seriously talking about pulling out. Why? Because they believe his progressive agenda could reshape the city in ways that threaten profits, stability, and long-term growth. That's the story we're diving into today. Are businesses really fleeing NYC in droves following Mamdani's election, or is this more hype than reality? And what would it mean for the city's economy, its tax base, and its place on the global stage? Let's break it down. Zohran Mamdani, just 34 years old, is now poised to become New York City's mayor. He won on a bold, progressive platform: rent freezes, free childcare, city-run grocery stores, and a long-term goal of a $30 minimum wage. For many New Yorkers, that vision is inspiring. But for some business leaders, especially among the ultra-wealthy, it triggered panic. Commercial real estate tycoon Barry Sternlicht, for instance, has openly said his firm is considering relocating because of the new administration. One of his key worries? That more pro-tenant policies will embolden rent non-payment and make commercial leasing riskier. Meanwhile, major restaurateurs are already pulling back. Stratus Morfogen, a well-known figure in NYC's hospitality world, canceled plans for 3 new locations, citing concerns about Mamdani's progressive economic policies and his approach to policing. Richie Romero, another hospitality leader, echoed that caution, pausing major projects in New York and looking more closely at markets like Atlanta and Dallas. On the political front, some business leaders aren't just nervous, they're mobilizing. After the election, New Hampshire's governor even sent a van into Manhattan, encouraging businesses to relocate north with a clear pitch: lower taxes, less red tape. For many, it feels like the exit doors are opening wide. So is this really an exodus, or just a noisy threat? To answer that, we need to look at the deeper currents: what Mamdani's policies actually propose, why they're terrifying to some, and whether these fears are grounded in data or in political theater. First, let's examine the heart of Mamdani's vision. He ran on progressive reforms aimed at affordability and equity: universal childcare, rent stabilization, city-run stores, and a plan to build 200,000 new affordable housing units over the next decade. He also laid out higher taxes, especially on high earners and corporations. That's what's making some investors nervous. In their view, a shrinking profit margin is just the start. They worry the very tax base that sustains NYC's massive public services could erode if the wealthy pull up stakes. As one real estate broker put it, money goes where it's welcome. And it's not just taxes. There's also concern over public safety, tenant protections, and how aggressive new tenant-friendly policies might be. Critics argue, will this embolden non-paying tenants? Will eviction protections make it harder to manage commercial properties? These are real fears for landlords and developers. On the flip side, not all business leaders are bailing. Some, like JP Morgan CEO Jamie Dimon, said they're not making quick decisions about their presence in New York. Billionaire investor Bill Ackman, who opposed Mamdani, actually offered to help him now, signaling that some want to find a way to make it work. So, what's really going on? Part of this storm is political theater, business leaders flexing their muscles, but part is very real risk management. People are hedging, reducing their exposure, and quietly exploring alternatives. A mass exodus hasn't fully materialized yet, but the threat has rattled enough confidence to start shifting conversations. As we dig deeper, the key question becomes, if a serious number of firms leave or reduce their footprint, what's the long-term damage to New York's tax base, job market, and its global standing? And could this risk spiral into something much bigger than just one election? Now that we've laid out the big picture, the anxiety, the threats, and the first tremors of potential business flight, let's dig deeper. In this part, we'll examine how real the risk is, what mechanisms could drive firms away, and where the fault lines lie. To begin, the jitters among business leaders are not purely rhetorical. Several high-profile players have made concrete observations. Starwood Capital CEO Barry Sternlicht has warned that under Mamdani's rent freeze proposal, default risk could spike. He argued that tenants might stop paying rent if they feel empowered, and that could destabilize commercial and residential landlords alike. On the financial side, one of the clearest danger zones is bank exposure. Take Flagstar Financial, for example. Analysts estimate that between $16 billion and $18 billion of their loan portfolio is exposed to New York's rent-regulated buildings, roughly a quarter of their total multifamily portfolio. If rents are frozen, their projected income from those loans could be seriously compressed. Then, there's the fiscal risk for the city itself. Mamdani's proposed millionaire tax, a 2% surcharge on income above $1 million, has raised red flags. The idea is to generate more revenue to fund his expansive social agenda. But some economists point out a paradox. If the very millionaires who'd pay the surcharge leave, the tax base could shrink, undercutting that revenue stream. And it's not just individuals. Critics also argue that Mamdani plans to raise the corporate tax rate, perhaps as high as 11.5%, according to some reports, that would make doing business in New York significantly more expensive, especially compared to lower tax states. Florida, for instance, is emerging in business rhetoric as a destination for firms reconsidering their New York footprint because of its more favorable tax climate. These are not hypothetical fears. Some business leaders are already acting. For example, certain Wall Street and corporate figures are reducing exposure to New York City grocery magnate John Catsimatidis, whose Red Apple Group runs Gristades and D'Agostino stores, has flagged a possible move of his company headquarters to Florida. Beyond taxation and regulation, public safety concerns are also part of the calculus. Sternlicht, again, has cited his worry that under a progressive mayor, policing could become weaker, which, in his view, would undermine the predictable rules that make urban investment viable. For many business leaders, it's not only about cost, it's about risk. If NYC becomes less safe, that could hit both talent retention and real estate demand. That said, not all analysts are ringing the alarm as loud as investors. Some real estate brokers are urging caution before calling this an exodus. According to The Real Deal, a number of them dismiss the narrative that a mass flight is already happening. "Everyone's leaving? I wish," one broker said. Another broker pointed out that ultra-wealthy buyers are still making luxury purchases in the city, including multi-million-dollar penthouses. In short, fears may be real, but they don't yet reflect a full-blown collapse in demand. Part of that moderation comes from even skeptical industry players acknowledging that Mamdani's diagnosis of New York's problems resonates, especially around housing supply. Some developers believe in the goal of building 200,000 permanently affordable units, but they disagree sharply on how to do it. They warn that freezing rents without addressing the financial viability of landlords could backfire. Another critical piece: governance and limits. As of now, Mamdani's power to unilaterally enforce every campaign promise is constrained. Tax changes of the magnitude he's proposing would likely require state-level action, not just City Hall. That means some of the worst-case scenarios being discussed might face political or legal roadblocks. Even Governor Kathy Hochul has signaled resistance to raising taxes too aggressively. There's also a conceptual tension. For business leaders, the risk is not just economic, but perceptual. The Mamdani effect, as some call it, may be less about immediate exits and more about long-term hedging. Fortune reports a sharp uptick in home buyers moving out of the city into Westchester County, not necessarily because of housing trends alone, but because affluent New Yorkers are weighing their future under a left-leaning mayor. The migration isn't just corporate, it's personal, among wealthy individuals balancing their roots in NYC with the realities of tax risk. Meanwhile, some researchers are doubling down on the exit narrative. Michael Toth, a fellow at the Civitas Institute, warned that wealthy New Yorkers might flee first to the suburbs, then beyond, signaling a stampede if Mamdani's policies go full throttle. For him, this isn't just about housing or tax, it's about New York's identity as a global business hub. So, where does that leave us? The risk is multidimensional: financial exposure, reputational risk, regulatory uncertainty, and migration of capital and high net worth individuals. But it's not a guaranteed collapse. Some business leaders are hedging, others are watching, rather than running, and not everyone believes the worst-case predictions will materialize. The political reality might moderate radical ambitions, and many tax or regulatory changes need broader institutional support. So let's step back and ask the big question: what really happens if businesses and wealthy individuals start leaving New York City in significant numbers? And could Mamdani's win spark either a crisis or a transformation? First, consider the tax base. New York City generates roughly $95 billion annually in revenue, with a substantial portion coming from high earners and corporate taxes. If a sizable chunk of that income moves out, whether through physical relocation or aggressive tax avoidance, the city could see a revenue shortfall in the billions. That's money used for schools, police, infrastructure, and public services. Suddenly, a progressive agenda funded by higher taxes on the wealthy might hit a hard ceiling. Second, there's the talent question. Companies often follow talent. If high-paying jobs or financial institutions relocate to Florida, Texas, or New Jersey, it's not just office space that leaves. It's human capital. Young professionals might follow the jobs, draining the city of innovation, entrepreneurship, and consumer spending. That ripple effect can be profound, affecting everything from real estate prices to local retail sales. But it's not all doom and gloom. Some economists argue that a progressive agenda could retain a different kind of value. By investing in housing affordability, childcare, and public services, NYC could attract younger, highly skilled workers who value quality of life over ultra-high salaries. The city's economy might slowly pivot from being dominated by billionaires and Wall Street to a more diverse, tech, and service-oriented ecosystem. It's also worth noting that history offers lessons. NYC has faced exoduses before. In the 1970s, the city teetered on bankruptcy, crime was rampant, and the wealthy fled to suburbs, yet the city recovered. Times Square was revitalized, Wall Street boomed again, and New York became a global magnet for innovation and culture. Could Mamdani's policies spark a similar, albeit different, reinvention? Perhaps. Here's another lens: perception versus reality. The business exodus narrative might be amplified by media and social networks. A few high-profile executives moving or pausing investments can create a sense of panic, even if the vast majority of firms remain. Psychology plays a big role. Once investors sense uncertainty, hedging behavior accelerates, sometimes independent of the actual policies in place. Now let's talk about timing. Real economic shifts take years, not months. Tax changes, regulatory adjustments, and corporate relocations are slow processes. Even if businesses start considering exits, the effect won't be instantaneous. Some might hedge first, moving satellite offices, or incorporating in states like Delaware, Florida, or Texas to minimize risk while staying physically in New York. Others will double down, betting that early fears are overblown. Ultimately, the story of NYC post-Mamdani may not be a simple narrative of collapse. It could be a complex balancing act between risk, opportunity, perception, and policy. Will the city lose some wealthy residents? Almost certainly. Will companies pause expansion or consider relocation? Some will, but a total flight seems unlikely, at least in the short term. The real takeaway is this: New York City is entering an era of uncertainty, not inevitability. Policies will be tested, markets will respond, and both risk and opportunity will coexist. Business leaders will hedge, policymakers will negotiate, and New Yorkers, wealthy or not, will adapt. For investors, entrepreneurs, and policymakers watching closely, the lesson is clear: understand the nuances, don't panic at headlines. Measure both the economic fundamentals and the political currents. New York is still a global hub, and while its future may shift, its core engine of talent, finance, and culture remains powerful. So, what do you think? Will Zohran Mamdani's win trigger a real exodus, or is this just another chapter in New York's long story of reinvention? Drop your thoughts in the comments. If you found this breakdown insightful, make sure to like, subscribe, and check out our other deep dives into finance, economics, and urban policy. There's a lot more to uncover, and New York's story is far from over.